Well, for decades, only banks could offer checking accounts, saving deposits in banks, and they were the main investment medium by individuals for earning interest on savings. Banks also serve the public's borrowing needs by offering loans. With deregulation of banking industry beginning in 1980, consumers soon discovered new financial alternatives. Mutual funds, for example, began attracting individual investors so that 1993 marked the first year in which money invested in mutual funds, almost $2 trillion, equal to the amount deposited in the US banks. Since then to the present day, financial industry competitors have grown faster than commercial banks. As consumers continue to look for alternative financial services, commercial banks and savings and loans associations find themselves with a dwindling share of the market. Borrowers today can get loans from investment banks, which are not the same as commercial banks, as we explained them, such as Merrill Lynch, which has originated billions of dollars in commercial loans, formerly the province of commercial banks. Savers too have switched their savings into the money market funds, stocks, and bonds that are offered by companies such as Charles Schwab, instead into the traditional saving accounts offered by banks. Many observers contend that to compete, banks must also diversify their offerings. The only way that they can compete, says banking analyst Thomas Brown, is to transform themselves into successful retailers of the financial services, which involves dramatic, not incremental change. In efforts to regain competitiveness, the banks were merging at a record setting pace in 1990s, a trend that continues today when commercial banks merge with investment banks. The resulting companies hold larger share of the financial market and the lines become blurred between traditional banking and non-bank financial institutions. Citigroup Incorporate, for example, was formed as the result of 1998 merger between Citicorp as a commercial bank and Travelers Group, which includes the investment bank Salomon with Smith Barney, and further mergers have resulted in Citigroup as well, the largest US commercial bank with nearly $1.4 trillion in assets in year 2003. The company, including private banking, credit card services, mortgaging, mutual funds, stock brokerage, and the brokerage services and insurance services and loan services. Mergers are the trend, and the fewer but larger banks are offering wide range of financial products. The strategy streamlines operations to reduce cost and focuses on providing products that will win back customers from non-bank competitors. Commercial interest rates. Every bank receives a major portion of its income from interest paid on loans by borrowers. As long as terms and conditions are clearly revealed to the borrowers, banks are allowed to set their own interest rates. Traditionally, the lowest rates were made available to the bank's most credit-worthy commercial customers. That rate is called prime rate. Most commercial loans are set at markups over prime. However, the prime rate is no longer a strong force in setting loan rates. Borrowers can now get funds less expensively from other sources, including foreign banks that set lower interest rates. To remain competitive, US banks now offer some commercial loans at rates below prime. Thrift institutions. Thrift institutions are the thrifty industry, generally encompass mutual saving banks, saving and loan associations, and credit unions. Historically, the thrifts were started to provide services that the commercial banks did not provide or were prohibited by the regulation from providing to financial consumers. While today's thrifts have many of the same services as commercial banks, some differences remain in services offered and form the institutional ownership.